Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got to catch up with Chris Zhang. Chris is my partner, the CIO of Ascend Interplay, a multifamily office. And he has a macroeconomic perspective that we love to tap into. He thinks a lot about the markets, broader shifts, what's going on in the government, the interest rates, et cetera, and kind of pulls all the pieces together in a very macro context. So we have a great conversation coming up on that, a little review of 25, and a lot of conversation about what's coming up in 26. So with that, here's Chris. Chris, great to have you back on, my man.
It's been a while. Glad to be back.
So we've got a lot to talk about because it's been a long time.
Yep.
And every week is a new week in your universe.
Mm-hmm.
Do you want to do a quick recap of 25? Now that you kind of have the benefit of some hindsight, what were kind of the major market themes, dynamics? What did we learn in 25?
Big question. We don't have a lot of time. Here we when we do these things internally, we do a deeper dive. But here, let me try to focus on what I think are the highlights. The 2025 really, if I have to summarize in a sentence, I think it's a year that defied gravity. Going into so at the end of 2024, coming into 25, market expectation around global GDP was 1%, high 1%, low 2%. We ended the year at 2.8% globally. Right. That's a big difference versus expectation. Global markets, there's almost nowhere you can go that didn't go up. But there's a big difference between, let's say, U.S. expectations coming in and what happened in the U.S. versus the rest of the world. I have in my hand some data points. For instance, MSCI All Country World ex-U.S. rallied 29% on the year. This is equities ex-U.S. S&P, as we all probably know, rallied 16%. So it's a big underperformance, U.S. versus the rest of the world. And there are a lot of themes that went into that we can probably touch on. So, and this similar theme applied across really all asset classes. The big one, I'm sure we'll talk about, commodities, gold and silver truly outperform. I believe gold rallied around 60%, silver almost 150%. That's on top of already 3-4 years of historical rallies. And same thing goes for really credit and global bond markets. And credit remained at the tights, and only in Q4 softened a little bit. So I would say almost nowhere you can go that really didn't defy gravity in 25. And so it's been a stellar year, and obviously boosted by AI and boosted by not just the valuation of AI, which a lot of people talk about, but really the first year that AI translated to real productivity boost and real earnings. So big year. Okay. So you mentioned gold and silver. Yep.
It's something I've always had on my radar, but internally you've been harping and singing the song on these for months and months now.
A couple of years now.
Yeah. What's the backstory? What's the narrative on gold and silver, and why it's so significant right now? Yeah.
So there's no argument against this, that we're in a structural bull market for rare earth and gold and silver commodities, bullions. Why is that? Well, everyone talks about sort of the debasement trade. There's really two parts to that. One is truly dollar as global, the status of reserve currency. It's been like that way for many decades, and people are sort of staying, finally trading away from that. But there's also debt, and this is not just U.S. debt, right? Debt is an issue globally. Especially for most developed markets. Maybe there are a few exceptions like Germany and whatnot, but most of the developed world, and I would put China in that category now too, has a debt problem. And so historically, what was viewed as a safe haven asset like US dollar debt and maybe Japanese debt are no longer safe havens. So then it begs the question, what else can you go to? And there's truly not a lot of alternatives. You can, some people are trying to argue that, Bitcoin or digital assets are becoming more of a sort of safe haven asset, we're not there yet. I mean, volatility dropped significantly from what used to be almost 100% a year, now 40%. Still a long gap towards something like a gold, which historically had 10%, 15% annualized volatility and hundreds of years of track record of sort of as a great holder of value. So that's, to me, the debasement trade, the debt issues are probably what's driving a lot of this. But there's also, for other type of, not just gold and silver, but for copper and other rare earth metals, there's a lot of tailwinds when it comes to AI. And you need these rare earth metals in building out data centers, in building electronics. And so there's a lot of that tailwind, not to mention geopolitics and domestic regulations that are creating these tailwinds. So we're definitely in a structural bull market, no question about it. And that stays intact despite the recent, if anyone follows sort of the gold and silver crash, I'll call it a crash I think a few weeks ago, really. Despite all of that, there's no argument we're still in a structural bull market. And I would argue even that so-called crash is a very healthy move. It was a right reaction to the right headline, namely Kevin Warsh being nominated as the Fed chair, as opposed to Kevin Hassett, who was definitely a dovish Fed chair. Would have been a dovish Fed chair. So it's a warranted move. And there's a lot of deleveraging in the system that especially it happened, especially in Asia, China, Korea, a lot of margin requirement increases that caused the initial drop. So it's a healthy move, and sure enough, markets kind of been grinding back since. And yeah, I don't see this trend, let's say, necessarily changing at all for 2026.
Right. So two trends.
Yep.
Minerals are increasingly in demand.
Yep.
As we're building out new infrastructure. And there's a store of value that may be a hedge against, I don't know, financing risk with the U.S. government and other governments. So what's the scenario where people would flip the story when they would say, "Hey, we're going to start selling off gold now"?
Great question. Yeah.
You know, if you buy gold, what are you betting won't happen?
Great question. That's one of the first things I think about when these days we're recommending more sort of piling into gold exposure. So if you look at, I would argue sort of 2000 is a pretty good bifurcation. Before that, we're in a different world now. After, so if you look at gold markets and really commodity markets since 2000, you notice that there's this period started around in 2013, ended at around 2019, where gold did nothing. So global equities rallied, gold did absolutely nothing. For almost a decade. And you ask yourself why that is. And it's ultimately comes down to, if for those of you who are sort of interested in financial history, that's the period where we're in a Fed tapering environment. All that means is the government starting to pull back on their balance sheet deployment, and interest rates are in a rising trajectory. So hiking path. But more important, not just interest rate, I want to make that clear, is also a lot more about how the government are spending their money and what the balance sheet looks like. So if we're in a tapering environment, and what could cause the tapering environment, a lot of things, inflation is one of them. And that's where, to me, safe haven assets, and especially during a period where there's not a lot of geopolitical risk and uncertainty, which was the case back then. You're in this sort of almost triple whammy situation where it's the risk premiums coming down. You're not in a negative rates environment. Your Fed is tightening balance sheet. So any asset, just logically, any asset that doesn't really generate cash flow will suffer. And gold is at the center of that. So that's the environment that you want to avoid. And if you ask me, what's the probability of that environment coming back? Because that's really the question here. To me, it's low. I think for a lot of reasons, which we can touch on, inflation is most likely contained for the time being because of AI, of course, as a deflator and other reasons we can touch on. But inflation is likely not going to be a driver anytime soon. And the Fed, even as with Kevin Warsh as the chair, is under a lot of pressure to at least, I wouldn't say necessarily cut rates, but at least not to increase rates because of the debt issue, because the political pressures. Of course, Fed is supposed to be independent. We all kind of know it's not true. So there's definitely political pressure being built in here. So it's difficult to price in a very hawkish Fed anytime soon. So that is the reason I think the risk is relatively mitigated. Yeah,
it's an interesting moment. So what's up next for 26 as the year's starting up?
Yep.
What's coming down the pike here?
I'll do what I did with 2025. I think one sentence. I think 26 is going to be another, I would say, cautiously constructive year. The momentum from 25 most likely will carry over. The themes mostly stay intact. However, a lot more so than 25. There's some wild card factors that weren't really around in 25, and now is definitely coming to view in 26. That can it definitely will become hurdles along the way for growth, and but could even if it blows up, it can really even change the direction of where we're going. And to me, one of the main wild cards, there are a few, but one of the main ones is unemployment. So or labor market. What's interesting about that is, for those of you who kind of are interested or think this period is similar to that of early 2000, unemployment, when the internet era sort of came about, unemployment went up to 6.5%, and we're currently still, in a sort of 4% range. And is that going to happen again? I mean, everyone's looking at headlines, these big tech company cutting labor, and not just white collar, really just across the board, service businesses, and with the robots coming on, there are a lot of reasons to argue that at least U.S. labor market will be a challenge, let's say, going forward. But the other side of it is, of course, we're seeing the data now, but also looking at the news. There's also a bit of a shortage of labor now with sort of, call it international. I don't want to get political here, but with a lot of sort of previously international cheap labor, now less available compared to last year's. It doesn't take as much. You don't need the U.S. as an economy does not need to add as many jobs, and that number currently stands around 70,000. So 70,000 jobs is all it takes on a monthly basis, new jobs net added, for unemployment to stay where it is. So NFP, we're talking today, NFP, so just came out, and it was a crazy number. It was $130,000, 130,000 jobs that was added last month. So clearly the impact of AI has not trickled in yet. But if it does, and just like it did in early 2000s, this could be what really changed everything. Because then you're forcing the Fed into sort of a particular way of doing things, and they will have to probably stay accommodated for a long time, which has major implications on debt levels and de-dollarizations, right? All of these are sort of entangled together, and labor's at the center of it.
On this one, I have strong opinions on where AI is going.
Yep.
And I really personally believe we're still in the first or second inning.
Yep.
It's just foundational models now. It's just starting to be distributed in the application layer. The AI story has not been written yet, in my opinion.
I agree.
And the impact it's going to have on the labor market has not been written yet.
Yep.
So for those who are, they know about AI now, nothing happened. It's not that, I think they may not be seeing what's coming.
Yeah, I totally agree. Even outside of AI for 26, I'll just kind of wrap 26 with this is, so, IMF, World Bank are predicting call it around the same 2.8% global GDP growth. And a lot of that, of course, is because of AI and AI spending in general. So basically, the view is we're going to be having a similar constructive, positive year from a global growth perspective, but the sort of the dispersion underneath that is quite large. So you're looking at India potentially at 7%, China at 5%, whereas US at 2%, and Japan as even lower, and much of Eurozone is around 1%. So it's a big dispersion, and the impact is not going to be the same globally. So it's I think will be, at the end of the day, it will be a good constructive year, but with bigger differences than what we saw last year.
So as of this recording, there's kind of a Middle East standoff.
Yep.
U.S. is armed and equipped all around the Iranian neighborhood.
Yep.
What happens if, from a financial perspective, if the Middle East conflict escalates?
Yeah. So this is this is sort of the same topic almost every time when there's any conflict in the Middle East. Everyone sort of immediately goes to oil, specifically Iranian oil, which is still supplying such a big part of the world's supply. The difference this time around, I would say, is the oil market is well supplied, and based on data, so global, based on I think data from OPEC, global oil supply this year, currently at least, is outpacing demand by about 3 million barrels a day. Okay, so what that means is, well, let's put that in context. So not a day, $3 million per year, right? But what that means is but the Strait of Hormuz, which we all know is probably the most important strait in the world, based on 2024 data, there's about 20 million barrels transited through that strait. So yes, there's a structural oversupply, but if there's significant disruption to just that, then you can look at an easy increase, right? That switch, that balance will easily flip the other way. So again, translating into data, looking at oil futures, right now there's only about a $4 per barrel price premium being built into sort of this so-called conflict that will likely last for a while, as we saw previously. So the market is not nervous yet. And oil definitely has tailwinds because of it. But no one's really saying that this will go to sort of $100 per barrel type of situation, where right now right around high 50s. But people are saying that the projection is that we're likely going to go to, call it 60s, 70s, which would mean that the impact on the subsequent impact, downstream impact on inflation, will be more or less mitigated by the deflationary factor elsewhere. So it shouldn't really translate to bigger data for the bigger economies, but it will create structural imbalances in parts of the world. So maybe not US, but maybe call it Europe. The potential for disruption is higher there than here, and also less so for the region, so the Asian countries. So again, the impact will be different, but should be mitigated, is the current view.
Now, are the trade wars over? Looking at this and all the way things are woven together here, right? There's also it's not just these conflicts, it's also the political motions, the sentiments. Right. Is that chapter, that was a big chapter last year. Is that kind of done?
I'm going to be careful answering this question here. Trade war, if you're just talking about trade war as is sort of narrowly defined by what kind of happened in April last year, I think that's over.
Okay.
But the broader trend is certainly nowhere near over. I think where we are today is we've shifted from this trade wars, the drama, and sort of with all countries, to this sort of starting to shift into this sort of permanent era of structural protectionism. And that protectionism is divided east and west, right? So there's globalization, but more regionalization, right? Less globalization, and there's structural protectionism between the two sides. So that's where we're in. I mean, we all saw what happened since April, right? There's a lot of bilateral negotiation happening. First and foremost with the closest trade partners, U.S., but also eventually with the rest of the world. And at the end of the day, we're looking at about, call it 10% average effective tariff, U.S. versus rest of the world, which is the highest it's been since World War II. That's the result of all of it. And going forward, I think this is nowhere near the full story. I think the story is going to be, okay, what is going to be the tariff on strategic assets like rare earth minerals, and so this is going to be negotiated over probably the next few years with specific counterparties, and the tariff is going to be all over the map. But let's just put it this way: the average effective tariff is not going lower, right? It's going to go higher, but it wouldn't really be broad based. It will be very specific. It'll be industry based. It'll be trade partner based, and that's likely to stay. And sort of the follow up to that is, if you look at, this is part of the anecdotal, part of it is database too. Supply chain globally is shifting from what used to be optimizing on price now to optimizing on geopolitical certainty.
Yeah,
for the long run, right? So which means there's definitely less emphasis on price, and there's definitely, that will translate into inflation and sort of consumer spending power and all of these things, because just given that that's no longer the focus. So I would say
it's not the cheapest price. It's
correct.
It's the lowest risk.
Yep.
And for most of these superpowers, that means a regional supply chain.
Yep.
Right. Trading with people that are, or countries that are across a border where you can access them.
Exactly.
Versus across an ocean, which may not be safe to transport across anymore.
Yep. Exactly right. And that's why you're, to me, again, we probably will talk about this, but this is the reason why you see a lot of headlines with South America. So what the current administration is trying to do, it's pretty clear, I think, to everybody. And China is making a lot of moves too. Don't get me wrong, right? Like both sides are trying to make sure their future supply chains are protected and de-risked as much as possible, and without relying on each other.
Right. Yeah. So it's not broad-based protectionism. It's the way I'm perceiving it is the U.S. is reorganizing incentives to create a supply chain in the new world.
Yep.
Right. They're trying to clean up governments. They're trying to make the neighborhood safer so that business can be conducted and we can have, from the U.S. perspective, have national security through supply chains, which is obviously critical. Yeah.
Both sides are, frankly, think the same way. Yeah. So just for their own
benefit. And the only group that's kind of in a super odd place is Europe, because it's not clear what neighborhood they're in, and
that's right.
They're not strong enough on their own right now.
Yeah. I think, they're probably trying to be their own neighborhood, their own ecosystem. But the fact of the matter is that they're neither the suppliers or the consumers. So they kind of have to rely on both sides. They're definitely in a tough position going forward. That's for sure.
So, given that obviously part of this new world integration that the U.S., I think we both hypothesized, is working on, a lot of the militaristic and political activity that the U.S. is doing in North and South America, is that... to me, it seems like the precursor of better economic integration, but it's messy right now. Is that a threat to economic patterns in the short term? Like for this year, does it seem like that's fear and risk? Or are people looking at that and saying, hey, these are thoughtful long-term stepping stones towards a more integrated supply chain?
Yeah. I will say it so from two different perspectives. It's a lot less certain, let's say, from the U.S. perspective, because you're definitely looking at a lot of short-term pain to decouple supply chain entirely from China. And let's be honest, the labor costs in South America is not the same as it's, a lot of countries, Vietnam and China, what China was 10 years ago, and India, right? So you're looking at you had to build out, and by the way, infrastructure is also not anywhere close. And so you need many years of building infrastructure and somehow while doing all of that, maintaining cheap enough labor and have government incentives in place to continue to encourage this move and basically take away sort of profit maximization as the number one goal for a lot of these private companies, and focus on something else and focus on safety. So it's a longer, I see it as a longer and definitely short-term painful process, but longer potentially beneficial. But it's just the potential at the moment. Like, it's very difficult to see. So the picture is very unclear from the U.S. perspective. However, if you look at it from the other perspective, I think it's a lot more clear. If you're one of the sort of South American countries, you're receiving almost unlimited capital injection at the moment. And you're receiving so sort of these help, call it, of a stabilization, right? We saw that, I think it was a $20 billion, $20 billion, or $200 billion stabilization debt to Argentina, right? There's a lot of help coming from US and really the Western world on helping them to stabilize the economy and grow their infrastructure, and which will then translate to sort of, if you're an average sort of middle class in those countries, will likely translate to higher earning power and all these things. So to me, I think it's almost a decisively economically positive thing, right? This is not, so I'm not talking about politics and the humanitarian side, but from an economic perspective, this is a strictly positive thing for most of these South American countries. And at the end of the day, if sort of this sort of northern this sort of Americas, let's say, becomes its own closed loop of supply chain, I think that'll be probably good for both sides, for everybody, and everyone sort of involved in the Western world. But whether we can actually get there, I think is still in question. Yeah. And if the U.S. Put in so much money and built the infrastructure and at the risk of increasing debt and sort of it further destroys the confidence level on the dollar, and without accomplishing the goal at the end of the day because the math just doesn't work, that's where you see things can really blow up.
Right.
So,
you got to work with the assets in that supply chain, the new world, which are certain labor rates and everything else. So there will be price adjustments accordingly, et cetera.
Yep.
The the elephant in the room still is the U.S. and other countries, but the U.S. in particular has this massive bloated debt.
Yep.
And it's hard to imagine how we get out of it. I know there's different strategies around inflation and monetary policy. There's all things people can do. It seems as though it's to a certain extent been put on the back burner.
Yep.
While we're trying to get this reorganization going.
Yep.
I have wondered if there isn't a masterstroke happening. Simultaneously, where in the process of helping to reorganize the supply chain through the moves in Venezuela, which are complicated, geopolitical, military, all the stuff, all the human stuff is complicated. But if you just abstract it down to, hey, they're trying to make a government more stable so they can become a trading partner, you can make the argument that that's this part of this closed loop supply chain concept. I've wondered if access to the oil reserves in Venezuela don't have a way to help mitigate American debt. And obviously there's questions around, how are you involved in that economically from the American side and everything else. But the oil reserves in Venezuela are very valuable. I went on to one of the AIs and came up with that they're worth about half of our total debt level. So there are these natural resources floating in this hemisphere that I wonder if as part of these shorter term strategies might deliver some longer term solutions around the debt side. How does that stick for you?
Yeah, maybe. I think the question, so the oil side, that's interesting. My view is the administration is not really thinking about specifically the oil in Venezuela as necessarily a way to pay down the debt. I think they're thinking of that as more of a long-term strategic asset to what they're trying to build infrastructure-wise and most importantly to sort of protect, so keep it, let's say, on this side of the world and as opposed to the other side. If anyone's been sort of more in tune with what happened in January in Davos, the World Economic Forum, the administration made it very clear how they're trying to solve the so-called debt problem. So they're trying to triangulate with three different things, right? One, it's deregulation, which is obviously good for growth, corporate regulation.
So
two,
grow the business.
They're basically trying to grow out of the problem, right? That's the essential. But how are we going to do it? Three things: deregulation, lower taxes, and which again is good for growth, and three is tariffs, right? Tax revenue. So this is what the administration openly for a year now has been saying, and they made it very, very clear a couple of weeks ago that is still the plan. The market is not buying it on the other side of it. How do you know, and why do I say that? Well, the fact of the matter is 10-year treasury is still above 4%. It's 4.1%. And long-term debt, 30-year debt is at 4.8 and it's almost 5%. So, and if you just observe what happened in the global bond market and pick your window, past year, 3-5 years, the trajectory is US is outpacing almost all the developed world on how much higher the yield is rising on their sovereign debt, right? So the market is not buying this particular plan that the government is laying out, even though that's all they've been trying to say, right? So,
but this is the challenge with politics, right? Because you can kind of deliver some talking points, and the journalists will write about it, and maybe the book is shut for a minute on that topic. But all these things translate to math.
Yep.
And so you pull these three levers. The market's not buying it because someone's probably running the numbers saying, hey, it's not enough.
Yep.
So it is interesting. Do you see any other levers that you think they should be pulling
Yeah.
Well, how if you were going to sit in the hot seat and run the country for a minute, like, okay, you're going to drive growth. What would be the levers you would pull to try to handle the debt situation?
Yeah.
What do you think the market would respond to and say, hey, that's great. That's it. That's the chess move.
To be frank, personally, I think the administration made the right move in terms of appointing Kevin Warsh. To me, that's because the Fed is essential to deleveraging and of course setting interest rate, but really deleveraging the balance sheet. And that to me is the number one way to solve or at least mitigate the problem. And Kevin Warsh is someone, if you just follow his sort of policy stance as a whole, historically for the past 20 years, he's someone that likes swift, drastic intervention by the Fed, if and when the market calls for it, but get out of the way for the rest of the time completely, right? So no prolonged QE, no balance sheet expansion, basically just sit aside and just let market do its thing and dictate and only intervene when absolutely necessary, right? So there's a lot of other parts to it. Like his view on inflation is very interesting. But I think by doing it this way, you're starting in the right place to control for spending and deleveraging for the next 10 years.
So the concept here is kind of hold the debt levels constant, let the economy grow so that becomes a smaller and smaller percentage, and hold your breath for X number of decades until the lines cross.
Yeah, I think the government just, again, I think growth is the solution here, in my opinion, but you can't grow and spend a tremendous amount of money at the same time. That's not going to solve the problem. You're probably at the best case scenario, your debt level doesn't rise as much, right? But so you kind of have to do both. You sort of get the government, stimulate private sector by lowering regulation and lower taxes, great. But at the same time, also don't spend. And most of that spending, by the way, don't just come from the actual government, like the executive branch, but a lot of it comes from central banks and the Fed. So you need to really slow down on all sides. So I think they're making the right move here, and the thesis is the right, but it's just the execution is they're walking on a fine line.
How long will we know until will it take a year or 5 years to kind of look at it and say, okay, they actually are kind of sticking the landing. Now we just have to wait. Does it happen quickly, or does it take time?
It will become pretty clear in the next couple of years because that's the window we're looking at for AI. AI's boost to productivity, which is basically essential to the growth story they're trying to paint. We'll see data translating to labor market, translating to the earnings in the next coming quarters and definitely the next 2 years. So by then, I'd say in midterm is definitely way too early, but by the end of this, call it the presidential term, I think we'll be pretty clear on where we're headed. Yeah.
Okay. Fascinating. Well, thank you for coming on, Chris.
As always a pleasure.
It's scary as hell and mind-blowing at the same time.
Yeah, it's a pleasure.
Thank you, Chris. Appreciate you being on. Just a reminder for everyone, Chris is an SEC-registered RIA, so nothing he has said should be misconstrued as investment advice. Other than that, I hope it was super helpful. It's always interesting framing to kind of get the very, very macro perspective of what's going on and how it might shape the days to come.